I think whether you think that we're going to go up 5% for existing home sales or you think you're going to go down, we are at the lowest level when you adjust it for population in 40, 50 years, right? And
Absolutely.
so wherever we are now, I consider the trough, right? So
Okay.
how long do we stay in this trough? And even if we're up 5% next year or even 10% for existing, it doesn't matter. It
Yeah.
doesn't matter. It's the same place. It is the same place. And it could be up 15%. It's still the same place.
Alrighty, folks, we are back with the one and only Lance Lambert. First and foremost, Lance, I want to congratulate you on a very successful Resi Day. I loved all the talk tracks. I liked how you and Anthony ran it. Very short, crisp, to the point. Very well done. Nice job.
Thank you. And it was great having you there. The crowd really loved everything about your session and kind of your take on single family rentals and how people can get into the game.
I love it. Appreciate the opportunity to tell the story, hopefully inspire people, hopefully get people to ask themselves some questions. But really what I was left with after that event, because again, you asked every person on stage, what is it going to take to fix the housing market? Give everybody a magic wand, if you will. Why don't you kind of summarize what your takeaways were from that event? Because I know I have a couple, but I'd love to hear what your kind of summary was about Resi Day.
Yeah, so I think a big part of it is time, right? There's going to need to be time because housing moves incredibly slow in all directions, wherever it's headed. It moves very slow. And so we've seen a pretty historic deterioration in housing affordability. And coming out of that is just not going to be a magic wand. And the things that are, kind of touted as magic wands, those things could, in the short term, make it worse.
Yeah.
If you, accelerate a lot of housing demand into a place where there's not enough supply, problems can become bigger problems.
Yeah.
So I think time is a big part of it. And I think there's, a need for, a response from more new construction. And I think that goes back into the time. And if you have that new construction, you have time and incomes can pick up, you can start to, heal. That doesn't mean that we're going back to 2019, 2018 levels of housing affordability, because the truth there is that the whole 2010s decade after the bust is an anomaly for housing affordability. And, if you go back then and tell it to people, they'll look at you like you're crazy back then.
They will.
Then everybody still talked about housing affordability problems, right?
Yeah.
But the truth is that when you factor in home prices, mortgage rates, and incomes, that was the cheapest decade ever to be buying residential real estate. No. And even as home prices started to overheat during, the COVID boom, it was still fairly affordable. It was not until, really into spring 2022 when rates finally not only normalized, but then, the Fed was moving into the fastest rate hiking cycle in 4 decades. And so we went from an average 30-year fixed mortgage rate. And once we kind of got to 5, that's when, okay, affordability is not just back to the average. Yeah. Then beyond that, we're actually pushing into, historically deteriorated. Yeah. And so I think the time part got discussed pretty well. And, there aren't necessarily the magic wands that people would like to see. Now, in terms of unlocking the housing market, creating more churn in the market, that kind of goes back to time as well. And some affordability improvements on the rate side.
Yeah. I loved everything about that, your sessions, because you're right. Everybody was focused on time and supply. A lot of times I go to events like this and, the magic wands are demand. We're not there yet. We need to fix the underlying broken housing market in time, wage increase, affordability. It's slow. Nobody likes to hear it. But I was definitely encouraged by all of the speakers focused on either time or supply. Very, very well done.
Now, are there things that could be done at the margins that could be savvy, that could, move the needle? I think potentially one of the companies that was there was Rome, and they're essentially a Zillow that is just the listings that have assumable mortgages, right?
Yeah.
So FHFA loans, USDA, VA loans, some of these different mortgages out there that can be assumable, they've went out, bought the proprietary data. And so when those listings come up, they can identify them. And then they're creating services in-house to where a buyer could come to them and they can help work on both sides of the process, because there's a lot that the seller has to do as well. And, the mortgage side is just not incentivized to do assumable. They don't make as much money on them.
No.
And so they're trying to create that process. But even with that, assumable is going to stay a very small percentage of the market. And even if you reduce some of the hassle, still, unless buyers gain a lot more power in the market, a lot of sellers are still not going to want to go that direction.
I thought that was a wonderful talk track. And when I was in the audience listening to the guy talk about Rome, I was like, I think my audience would love to hear about this. I know some of my audience and some of my weekly experts have tried to do assumable. I think having a company focused on it, who's focused on both sides, getting through the muck of an assumable, I think they're onto something. And I think that might be something.
If you want to have Ronick on, I bet he would. I could reach out to him.
Yeah, I think my audience would love that conversation. So that's pretty cool. Well, I know I want to talk about 2025. That's something I'm doing with my audience. And really what I talk about with you is kind of the setup. I know you currently are collecting forecasts and all of that, so we'll hold that for another conversation. But when I think about the setup for 2025, these are the things that I'm thinking about. Number one, rates. I believe and have said publicly that I think rates are going to be higher than most people expect. I am on record. In fact, I think I responded to one of your tweets this morning that I think the average mortgage rate will be 7% for the year, right? We might end lower than that, but when we look at the year of 2025, I think mortgage rates will be 7%. And I don't know, it was 6-8 weeks ago, people were talking like 5.5 was a real possibility. So I think the first setup is rates. What do you think about higher for longer in 2025?
Well, I think the big thing that occurred this summer is that we had gotten a few unemployment rate readings where the unemployment rate quickly jumped to 4.3. And there's that history there where if the unemployment rate, especially in a Fed rate hiking cycle and after the cycle, if the unemployment rate starts to move up, you have to pay attention to that, because historically, small increases in the unemployment rate are often followed by really big increases, and it happens all at once.
Yeah.
And so we got the first move up in the unemployment rate that was noticeable, and it happened faster than expected. That caught the attention of the Fed. They went ahead and cut 50 basis points. And right before they cut the 50 basis points, we had the market pricing in slightly higher recession odds. We had the average 30-year fixed mortgage rate falling to 6.11 as tracked by Mortgage News Daily. The 10-year came down a bit. And then the Fed cuts 50 basis points. And right around then, we started to get, some inflation readings where it's like, okay, it's a little stickier than expected. Not only did the unemployment rate not go up anymore, it actually fell down a little bit. And then the jobless claims are still low. So the economic situation in terms of the labor market is more resilient than was expected. And then the next thing you know, the long-term yields and the average 30-year fixed mortgage rate started to move back up. And that's continued through early November. The average 30-year fixed mortgage rate today is about the same as still when the odds were 50-50, whether Trump was going to win or Kamala Harris. So the Trump win hasn't necessarily put as much upward pressure on yields as was discussed, but it hasn't taken them off either, because some of the things that, Trump is discussing, could be maybe inflationary, right? If depending on how far you go down the tariffs route, right?
Sure.
Tax cuts are technically stimulatory to an economy, right?
Sure.
And so the fact that it was a full sweep, and so there will be some policy, kind of leaves uncertainty on the fiscal side.
Yeah.
And I think that's where we are right now, with some uncertainty on the fiscal side. Inflation is maybe not going to, disinflate as fast as expected, and maybe could bounce around and give the Fed some fits. And then the employment side of the economy is still fairly resilient. And so I think when you zoom out, when you take all of that together, it's still the higher for longer, right?
Yeah.
There isn't a huge expectation of a move out of where financial markets are today. And that doesn't mean that we might not be at the higher end of the bound at the moment, but we might also, so maybe there's 50 basis points that we could swing down fairly quickly, but that's still really around the same place that we've been. So nothing too dramatic has changed.
Yeah, agree with all that.
And if it were, I think where you would see it first is the labor data, is in the
totally agree.
Employment rate, is in the jobless claims, it's in the job openings, all of that. That's where you would see it.
Love it. Love it. Well, I am again calling higher for longer, which leads me to transactions. Rough and tough, it looks like we're going to do about 4 million existing home sales in 2024. I am on record telling my audience and operators in the business that I think 2025 will be worse, meaning lower. Good news is I think 2026 is our up year. And again, I look at history. I look at 1978 to 1982. 82 was the worst year. We went down from 4 million to 2 million. I think 2025 will be worse. Call it 3.8-ish million existing home sales because of rates and the housing market still being broken. I think NAR, National Association of Realtor, I read earlier in the week, is actually calling for a 5% increase. So he's calling for 4.2, Lawrence Yun. But yeah, I think transactions, assuming rates are 7, I think we have one last hard year. What do you think?
I think whether you think that we're going to go up 5% for existing home sales or you think you're going to go down, we are at the lowest level when you adjust it for population in 40, 50 years, right?
Absolutely.
And so wherever we are now, I consider the trough, right?
Okay.
So how long do we stay in this trough? And even if we're up 5% next year or even 10% for existing, it doesn't matter. It doesn't matter. It's the same place. It is the same place. And it could be up 15%. It's still the same place, essentially, in a very low level. Mm-hmm. And so I think we're in the trough right now. And at some point, we will start to begin that long grind up. And it will be slow. And I don't think it's something that you'll miss. It'll build so slow. Now, I think one thing to point out is that we are in a place where the affordability of the market is a real headwind. And the lack of supply has been a real tailwind to the market. And so every year we've gotten a bit of a squeeze up in the seasonally strong spring period. And then we've gotten that squeeze down, almost like a tug of war. And so if you look at existing home sales, we've actually seen a pop up in the seasonally adjusted annualized rate, the SAR rate, every spring. We've started to move up. And every spring people have been like, we're moving in the recovery for existing home sales. Here we go. And then it literally collapses on itself. And once you get this start to get towards the tail end of spring and into the seasonally soft period. So, I think following the seasonally adjusted existing home sales sprints, you could start to see over the next few months, maybe them bounce up a bit, but it doesn't necessarily mean that is the sustained recovery for existing home sales. And I think the real thing there is you need time and you need some bit of an affordability improvement to get things, to get it moving up more.
Yeah. Well, next is going to be active inventory. Again, active inventory, I think much of the year has been increasing. I see no reason for that to change next year. I do think it's still distorted where luxury, meaning 2x the median, kind of stays on the market longer, where clean entry level still moves. But yeah, I see active inventory increasing 10, 15, 20%, next year. I think the trend continues.
Yeah. What's interesting is I hear so much conflicting information on that. Ivy Zellman, she did an interview yesterday, and she said that they've seen more weakness at entry level and that they've seen more resilience at move up. But then I just, when I talk to agents, I talked to one in Florida the other day, and she said at the very high price points in her market, the 1.5, 1.7, that's where things have come down.
Yep.
The move up, that next layer is kind of fairly weak, and things are taking pretty long to sell. And then at the bottom of the market, the entry level is where they have the most competition, which that kind of goes with your theme of the market. And I think that's when you look at the data, and you break these numbers up, a lot of this local data, a lot of it is the higher price points make up a lot of the active inventory. And so I think the big thing I would be watching in my local markets is where's active listings, right? If you're still like seeing active listings push up at this time of year, right?
Yeah, that's a problem.
That should have your attention.
Yes.
If you've seen a seasonal rollover that's kind of about normal, your market might kind of feel about normal come next spring. And so I would be watching active listings in your market. How does it compare to a year ago? And then how does it compare to the same month in 2019? And use that as kind of your proxy for normal.
Yeah, well, let's just give you a shout out again. You're the data guy. You have all this data. They can just go to ResiClubAnalytics.com and really get access to your charts, pictures. And if they get the pro version, they can actually get your data sources. So if you want to go back and look at data in 18, 19, all of that, don't fret. Lance has got you covered. Is that right?
Yeah, that's right. And I could actually show, can you see my screen?
Let me just add it. So we're using StreamYard. So there it is. Yep.
Okay. So you can see the map?
Yep.
So this is the most important map that I do. It's active inventory now versus the same month in 2019.
Love this chart. Love it.
Where it's dark brown, which is a lot of the Midwest, Northeast, there's still fairly tight resale markets. And then in a lot of the Mountain West, Southwest, Southeast, really this Gulf area, you've seen active inventory not only increase, but increase above pre-pandemic levels. And this is where you've seen more weakness and where buyers have gained a lot more leverage in the market. So you take a market like Dallas, where, in October 2021, they were down to 8,000 listings. Compared to October 2019, 2 years earlier, they had about 24,000. Wow. Now we've gotten up now to about 26K. So they're 8-9% above pre-pandemic levels. And a lot of the active inventory build that's happened in Dallas has happened, and I have my county map where you can really see it. It's outside of the urban core, and it's these deep exurbs. And what happens in those deep exurbs? Well, there's a lot of home building, right? And the home builders are using the affordability adjustments, these buy downs, to move product. And in some cases actually cut prices when needed. And what that's doing is it's drawing buyers who would have otherwise gone to the existing market. Now they're like, you know what? These existing sellers don't want to play ball. I'm going to go to the builder. And that puts upward pressure on days on market and active inventory. And,
Love it.
And so this is a real key one that I do for my clients.
No, I think it's one of the best charts out there in the industry. People need to go to ResiClubAnalytics.com and get that chart for sure, that picture. Well, let's talk about price. Everybody is always talking about price. The good news is my call hasn't changed from a year ago. I think 24, 25, and 26 in hindsight will be very, very boring. We'll have seasonality bumps, but start and finish, real estate is going to be kind of flat. I think we got the decade of appreciation we got in the first couple of years. And I don't see prices going up meaningfully, and obviously don't see them going down. I think the median home price in the United States will be roughly the same, call it 1% plus or minus. That's kind of where we're at.
Yeah. Can you see my screen?
We can, yes.
Okay. So this is year over year. I went and got 4 of the major indices: Case-Shiller, FHFA, Freddie Mac, Zillow Home Value Index. And you'll see that they all kind of follow a similar pattern, right, with the year over year. Right now, all of them are somewhere between 4.3 for Case-Shiller and 2.4 for Zillow Home Value Index. So growing at 2 to 4, right, is kind of where we are. And so we're decelerating, although the Zillow one has started to stabilize now. Unless something dramatically changes, I think that's kind of where we are.
Yep.
Is kind of in that low digit level appreciation. Although depending on which industry you look at, that still could be real positive as well. Which, I think some people would like to see real down maybe a little bit. So you kind of get that affordability improvement. Now at these levels, you can still have markets where some markets are declining.
Oh, no doubt. No doubt. Yes.
Kind of where we are at the moment is you have 15-20% of markets, mostly around the Gulf, these markets that had a lot of migration during the pandemic, a lot of like the Airbnb buying, now are also getting hit by home insurance shocks. So those are kind of like, some of the markets that you could potentially see down.
Yeah, totally agree with that. Well, at the end of the day, I think 2025, we still have a broken housing market. I think the move-up buyer is still very much on the sidelines, certainly as rates stay at or near 7%. If you're in the industry, commission, broker, appraisers, my opinion, you're going to have one last hard year, which will cause attrition. Then when you get to 2026, it might feel like a buffet where your business is up 10, 15%. But guess what? Your competition is down 50%. So we will have plenty of folks starting to gorge in 2026. But again, we've got to get through 2025. Lance, closing thoughts, and where can people find you?
Yeah, if people want to find me, they can find me at News Lambert on Twitter or X, ResiClubAnalytics.com. You go there, you put in your email, you could get into my free list. I also have a premium newsletter, Resi Club Pro, for my paying audience. That's 3 additional research articles per week, access to a lot more of my charts and maps for local inventory and price data. And I think the thing, my final thought here is that, nothing too significant has changed in housing in a bit, and everything's kind of moving real slow, and we kind of get where the picture is at the moment.
I love that. Again, one of the things we've talked about for years on this channel is real estate moves slower than a lot of these fake gurus and crash bros talk about. There's not these cataclysmic events in housing. It is much more sticky and slow. Lance, you're amazing. Keep it up.
Thank you for having me.